Markets are really interesting right now. Even though it's summertime, and summers they tend to be a bit quieter as people take holiday and they take their kids on vacation, what makes it interesting at the moment is one word.
Inflation.
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 Inflation. Inflation.
Inflation. Over the last couple of months, the CPI index came at around 4 to 5%, which is the highest level that it's been at since 2008 financial crisis. And even though the Fed doesn't use CPI as its measure of inflation, it is also much higher than the Fed's target rate of 2%. The Fed has already came out saying that there is nothing to see here, everybody needs to calm down, the inflation is just transitory and will return to its previous levels.
Nothing to see here, please!
Whether or not that's the case is exactly what everybody is watching at the moment, whether this is just a small blip, as Fed's saying, or if it's a sustained move higher. Because if it's the latter, then we might be coming to an end of a party that has been going on for the last 13 years. What kind of a party, Sergey? That's an excellent question, and that's exactly what this video is about. Welcome back. First of all, I'd like to say a big thank you to everyone who has shared and liked my previous video. Your support means a lot to me. If you're new here, on this channel we talk about finance and financial markets a lot. So if that sounds interesting, please click the subscribe button and join the community. So why is inflation so important right now? Well, let's have a quick look at what has happened over the last 13 years. Since the 2008 financial economic crisis, interest rates have been mostly zero in the US and broke many economic models by going sub-zero in some European countries. Money became cheap to borrow. And many took advantage of that because borrowed funds could be invested in other financial assets which offered a higher rate of return. It became cheap and easy to leverage, which drove asset prices higher. Many corporations could not resist the temptation of cheap money and started issuing their own debt. The proceeds of that debt were used to finance their share buyback programs, where companies simply bought their own stock in an attempt to drive their own share price higher. And since many major corporations did that, like Google and Microsoft, the entire stock market went up as a result. Following the trend, Fed decided to launch its own share buyback program, otherwise known as quantitative easing, and started purchasing government debt, depressing treasury yields across the curve. The money injected into the system had to find its way into other financial assets. The classical 60-40 portfolios, which consisted of stocks and bonds, performed exceptionally well, as bond prices and stock valuations both went up. However, on their own, bond yields did not offer sufficient returns, and many investors embarked on a noble quest in search for yield. And many have found it in the stock market, which in the meantime continued its climb, attracting more and more capital. It seemed that the stock market was one of the only few remaining investments which still offered sufficient returns. The term TINA became used in the context of equities. The party briefly stopped when the Fed attempted to reduce its balance sheet and started hiking interest rates in 2017-2018. As the Fed was doing that, S&P 500 fell 18% from its highs, and the Fed turned the music back on, citing weak global growth and other such things.
Federal Reserve cutting interest rates by 1/4 point for the third rate cut this year.
The party continued. The weak economic growth further deteriorated when coronavirus spread across the world in 2020. In order to stimulate economic growth and help pharmaceuticals fight the pandemic, the Fed throws a kitchen sink and applies all the tools it has at its disposal, including the famous bazooka.
It is an absolutely historic week, both in terms of the speed of Fed purchases and, of course, the magnitude.
The coronavirus seemed to justify the unprecedented levels of economic stimulus from the Fed, and the financial markets have reacted positively. Exponential and parabolic charts across asset classes took over the Bloomberg terminal. As the world population was still adjusting to working from home, or to being unemployed, the stock market has exceeded its pre-COVID levels and was continuing to make new all-time highs. The M1 money supply blew through the roof in 2020 and beat both GameStop and Dogecoin to the moon and back, twice. Classical economics and basic reasoning would suggest that with more money in circulation, there has to be some dilution effect, as much more dollars are now chasing the same amount of goods. Hence, all eyes are on inflation right now, as everyone wonders, will there be consequences to Fed's actions? Has the Fed managed to finally anger the gods of inflation and would have to raise interest rates and end this decade of cheap money? Is the party over, or will there be an after party at one of Fed's private clubs? Let me know what you think in the comments below. Thank you very much for watching, I'll see you in the next video.